You were on a couple of, maybe last appearance or before then, one of your main concerns was recession risk. And we've had some data points since then, and we don't need to engage in a semantic argument about what constitutes a recession, back-to-back quarters. But you said if there were to be a full-blown recession, that 3,000 was even possible as the worst-case scenario on the S&P. Are we likely headed to a recession, and as a result, is 3,000 still a possibility on the S&P?
Yeah, well, good morning, Joe. I mean, I do think that a recession is still, a 50-50 shot. We're not, it's not our base case. We're not in the 80% camp like some others, but definitely the risk is elevated. I think our main point over the last couple of months has been that earnings are going to be at risk either way. It's just magnitude of that risk. And, as we noted, 3,600 sort of priced in that risk of a earnings recession without an economic one. So it's a 5 to 7% decline in forward earnings estimates, as opposed to something more severe like 15, 20% decline in earnings if there's an actual recession with layoffs. And it's a much deeper affair in terms of the slowdown. So we don't know the answer. Nobody can tell the future. But I would tell you this, that at 4,200, the risk reward in either outcome is poor. And, I don't know what time, last time I was on this particular program, but we suggested, there could be a rally. We never thought we'd get to 4,300, to be honest. But, 4,000 was in the cards. That would be a typical range. So I think, look, the markets are doing a really good job of testing everyone. But I still believe we're in the midst of a bear market. I don't think you can say the coast is clear. Just like you can't say that a risk of recession is a foregone conclusion. We're in that unknown area.
If you were just purely looking at earnings in a rising interest rate environment, and that's what threw us for a loop last week and this week, because any type of Fed pivot looks like we may have been overly optimistic. But in a rising interest rate environment, don't you have to worry about multiple contraction on the earnings that you just said were going to be not stellar? So then you got to apply a lower multiple too. So I don't even see how 3,500. I can see how you could get to below 3,500 based on that.
And that's exactly right. So now at this point, the price is wrong too, right? So at least in June, the price was right at 15.5 times. We thought that was always our target this year for PEs. We had a 30% decline in PEs. That's right in line with our forecast at the beginning of the year. But all of that, PE degradation, Joe, has come through the interest rate channel and, the Fed tightening. And that's in other words, it's before we've seen the earnings revisions that we think need to come. And now, though, we got back to 18 times last week, or 18.3 times. And that price is just not correct, given the environment that we're in, and the earnings are still too high. So, yeah, once again, that's how we look at risk reward. Whenever we make recommendations, we're always thinking about the context of what's my upside and what's my downside. I think a lot of folks, say, hey, the market's up, I was right. Well, okay, that's fine. Or the market was down, I was right. But you got to understand how much risk you're assuming to do that. And so look, at 3,600, the risk reward was skewed more favorably to the upside. At 4,200, the risk is absolutely skewed more to the downside.